Hey, good morning once again, options traders. Well, another one of my favorite topics in options is the idea of understanding how the put call parity equation relates to insurance. And it's a little difficult to explain, so we're going to take it slow. So this video might run a little bit longer than normal, but I want to make sure I'm covering all of the necessary parts so that you can understand it. But it's one of my favorite topics because I've talked to so many traders who tend to have the opposite viewpoints. And once you really see what's happening, I think it will help you to make better decisions with options, whether you're the buyer or the seller, and to also understand that sometimes when your call option goes bust, it's not necessarily a bad deal. So let's take a closer look at the put call parity formula and insurance. Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So you've heard me say this so many times before that calls are puts. And of course, puts are calls. And what that means is that anything that can be done with a call option can be done with a put. So for anybody who's new and says, hey, I heard about this butterfly strategy with calls, can it be done with puts? Yes. Put option is insurance. It guards the downside. Can we use a call to guard the downside? Yes. Anything that can be done with a call can be done with a put and vice versa. Now, normally, traders understand that put options, as a very good analogy, are like insurance. You own shares of stock, you buy this put. If the stock comes crashing down, the puts pay off. But if calls are puts and puts are calls, then calls should also be insurance too. And sometimes traders say, well, yeah, I get that because they still limit the downside. If you were holding shares of stock and it came crashing down, the call options are going to limit the losses. And that's true, but then there's also something else that goes wrong with that analogy. So normally when we talk about insurance, we say that the insurance company wins if the policy expires worthless, and the insurance company loses on that deal if it makes a payout. So if you pay your car insurance for the year and nothing happens, we would say, well, the insurance company won that one. I paid this money, I didn't get any kind of a payoff. But if you make that payment and then the insurance company has to write you a big check, most people would say, well, the insurance company lost on that one. So if you have that viewpoint, take a look at what happens and why that can be very confusing. So here is our profit and loss diagram for a call option. We have our bend at 100. So we've got our long call, and we can see that we have limited downside. If we overlay long shares of stock, in red right here, this is what we get. So now it becomes very clear that if you buy the call, and you're on this black line, you are limiting your downside. You're buying this call so that you're not being exposed to this potential risk. And again, this is where people say, yes, I get that, call options are insurance. But if that's true, we get kind of a contradiction. In other words, if the call seller sells a call, collects a premium, the stock is down here, and it expires worthless, we would say, well, the seller is the insurer, and the insurer won. Well, then how did you also win? Normally, you're on the opposite side, so one side wins, one side loses. I've talked about that in many videos. All of your Greeks are reversed. Your bias, whether bullish or bearish, is reversed. Everything is opposite. So if we see a long call option that goes bust, how could we have a viewpoint that it actually did its job? That it actually became an insurance policy? Because again, if we have that view, the call seller won and the call buyer won. So what's going on here? Well, the reason for this paradox is that there are really two versions of put-call parity. And I've talked about these in previous videos, so you can certainly search for them as well. But for a quick review, the first formula is stock plus put equals call. Of course, we can rearrange this in a lot of different ways, but this is a very basic one. So if we have a trader who is holding shares of stock in a put, the risk graphs would look exactly the same as somebody who's holding the call, assuming the call and the put have the same strike. So this is one put-call parity formula. What's the other? Well, the other is similar with the exception of this other piece out here. On the left, we have stock plus put equals call plus bond. See, up here we don't have the bond, we just have the call. This is a second put-call parity formula. And when I say a bond, what we're talking about is that the bond equals the strike price. So if this is a $100 call and a $100 put over here on the left, you would need a bond that pays off $100 at expiration of the call. And of course, being a bond, you'll buy it at a discount. So let's say it's a government bond. So if it pays off $100, let's say in a year, you might have to pay $98 for it, what we call the present value of that exercise price. But the point to understand is that when you get to expiration of the call, that this bond's value will be equal to the strike. So that's what that is telling you down here. So anytime I use the word bond here, that's what it's referring to. Now sometimes, just to make it a little clearer, I'm going to use the word cash, because this is really a cash position. So let's take a look at our first formula right here. Stock plus put equals a call. If we have a portfolio where we have stock plus put on one side and a call on the other, the changes in the portfolio values are the same, but the total values are different. And we call these a mimicking portfolio. So we would say that a call option is mimicking the stock plus put portfolio. So to show you what's happening, let's assume that we have two traders. Trader A is holding the stock plus put positions or portfolio, and Trader B is holding just a call option. Again, remember that the call and the put have the same strike. So why is this called a mimicking portfolio? And what do we mean that the changes in the portfolio values are the same, but the total values are different? Well, here's what it means. So in this table, we've got a list of stock prices, and the next two columns right here, the 100 put and the stock, are Trader A. This is the person holding the stock plus put portfolio. And so this is their total value. To the right of this gray line right here, we have Trader B, who is holding just the call. So now take a look at what happens at different stock prices. If the stock is 90 at expiration, the $100 put is in the money by 10 bucks. It's worth 10. So this trader is holding shares of stock worth 90 plus a put worth 10 for a total of 100 bucks. If the stock is 95, Trader A has shares of stock worth 95 plus a put worth 5 for a total of 100. If the stock is 100, the put expires worthless. Total position is worth 100. If the stock is 105, the trader has shares worth 105. The put again is out of the money, so it's worthless. Total position value is 105. Same if the stock is 110. So here is the total value of these two positions for Trader A. Now let's look at Trader B, who's holding the 100 call. The stock is 90, 95, or 100, the call goes out worthless. If the stock is 105, the 100 call is worth 5 bucks at expiration, and with the stock at 110, the 100 call is worth 10. Now here's what we mean when we say the changes are the same. If the stock goes from 90 to 95, Trader A's portfolio went from 100 to 100. Those are the values. In other words, it didn't change value. Look at Trader B, went from 0 to 0. It also didn't change value. If the stock goes from 95 to 100, Trader A's value goes from 100 to 100. Stays the same. It didn't change. Trader B went from 0 to 0. It also didn't change. Stock goes from 100 to 105. Trader A goes from 100 to 105. That's a change of 5 bucks. Trader B went from 0 to 5 bucks. That's also a change of 5 bucks. And then finally, when the stock goes from 105 to 110, Trader A goes from 105 to 110 for a value, and Trader B goes from 5 to 10. Both of those positions changed by 5 bucks. They share the identical change. But look at the totals. Trader A is worth 100, while Trader B is worth 0. See, Trader A is 100, B is 0, 100, 0, 105 versus 5, 110 versus 10. The total values are not the same. In fact, trader A is always $100 more, and that is the insurance policy. It's the value of the strike. And it's called a mimicking portfolio. And it's mimicking because the changes are the same, but not the total values. So if we were to look at this call option over here in what's called a payoff diagram, we're not looking at profit and losses, we're just saying what does the call pay off. For all stock prices at 100 or below, the call pays off 0. And for all stock prices above 100, the call pays off the intrinsic value. Okay, so kind of keep this relationship in mind in this picture. We'll come back and revisit it. Now let's take a look at the second put-call parity formula, where we have stock plus put, let's call this trader A, and trader B is now holding a bond. We're now comparing stock plus put to call plus bond. And if we do this, the changes in the portfolio values are the same, and the total values are the same. And that's why this is called a replicating portfolio. So think of the word replica. If you have a model car or an airplane that is a replica, it looks exactly the same. Might be a different scale, but it certainly looks the same. Everything's the same. And so that's a way to remember what a replicating portfolio is. The changes are the same and the total values are the same. So let's do the same exercise again. Trader A holds stock plus put, which is what was held before. Trader B holds call plus a bond. And again, remember that the bond equals the strike price. So now notice that trader B does have cash. This will be important later. In the first scenario, trader B did not have cash. He just had the call option. But now trader B has cash, and it's enough cash to exercise this call if the call goes in the money. So no matter how high that stock price rises, he can exercise because he'll have 100 cash, and that's also the same as the strike. So he can always exercise for the shares. So let's take a look at the replicating portfolio. Now everything to the left of this gray bar right here is exactly the same that we saw before. This is trader A. Here's stock plus put, there's the totals. But now look at trader B. This is what we saw before, the call options, but now he's got this cash. So yeah, he might have to deposit $98 or $95 depending on what the interest rates are and the time to expiration. But when we get to expiration or to maturity of the bond, we know it's going to be worth the exercise price. We've done that by design. We want to deposit enough money so that it grows to the strike price. So we know at expiration, in this example, it will be worth $100. So now look at trader B. Stock is at 90, call goes out worthless, but the bond is worth $100. He preserves most of his cash, so his total value is 100. Stock is 95, same thing happens. Total position is 100. Stock is 100, same thing. Call is worthless, bond is worth 100. The total position is 100. Stock is 105. Now look what happens. The call is worth 5, bond is still a fixed 100, but combined they're worth 105. And if the stock is 110, combined the call plus the bond are worth 110. Now compare these columns. Here's trader A's total value and trader B's total value, and they're absolutely identical. So not only are the values identical, but so are the changes. If the stock goes from 90 to 95, trader A's value didn't change. It went from 100 to 100. Trader B's didn't change, went from 100 to 100. See, they're exactly the same. Stock goes from 100 to 105. Trader A goes from 100 to 105. He increased by 5. Trader B increased by 5, going from 100 to 105. Everything is exactly the same. Not only the changes, but the total values. And this is why it's called a replicating portfolio. Changes are the same, and the total values are the same. And that's what this put-call parity formula means. Sometimes you'll want to use this version, and other times you don't. Those are really separate discussions when we get into strategies, but right now I'm just trying to do a quick summary of the difference between a mimicking portfolio and a replicating portfolio. So now let's look at Trader B's position here of the 100 call plus the bond. Now here's our payoff diagram. Remember, this is not a profit and loss, it's just saying what's the total value of these two positions. So if the stock is at 100 or below, the bond is worth 100. So notice at the very lowest level that this black line sits is 100 points above zero. It's guaranteed to be worth at least 100. And if the stock price rises, it's only worth more. So it's a subtle difference, but it makes a very big difference in the interpretations. So if we compare the two portfolios, here's our mimicking portfolio on the left, and here's our replicating portfolio on the right. Take a look at the payoff diagrams. You see how this is just the call. It can go out worthless for all stock prices at 100 or below, but the replicating portfolio has a minimum value of 100. Has the same shape, but it's shifted higher by $100 because in this portfolio, the trader holds a bond or cash equal to the strike. And once you understand this, there are really two different forms of insurance that are going on here. And this is why it can get very tricky when you're trying to figure out your strategies. And maybe if it's better to let a call option go out worthless or any number of questions, it really comes down to which portfolio we're trying to mimic. So the idea is that having cash or a bond to exercise for the shares changes the insurance. And again, this is a kind of a very tricky thing to see. So let's start with a long call. Let's say that you have just a long call. It's a mimicking portfolio. If the long call expires worthless, the question now is, did the short call position, or let's call it the insurer, win or lose? And then for a second question, did the long call, that would be you in this example, did the long call win or lose? Now most people would say if the call expired worthless, the insurer won, and the person that owns the call would be on the losing side because they're on opposite sides of the trade. But again, this is kind of a paradox. So let's go back to our payoff diagram. And if we look at this, remember that you do not have the shares of stock. You also do not have cash. That's being seen right here in this formula. So if you're buying calls because you don't have the cash to buy the stock, again, that changes things. We need to knock the stock out of the equation because theoretically you're never going to exercise for that. That's why you're just taking the call. So now notice that the call is acting as a put. So in this case, the call is insuring the downside risk. So if the stock is up here and it starts sliding and it comes down here, you could say that your call option paid off because you were never exposed to further downside. If you had purchased the shares, you would have been exposed to this, but you didn't have the cash for it. So instead, you buy the call and you're using it as a substitute for stock plus put. You're using it because you can't buy the stock and also buy the put. So again, when viewed in this light, the call option is acting as a downside insurance policy. All right, now let's look at the second portfolio, the replicating portfolio of call plus cash or call plus bond. So now the question is, what if you do have the cash to exercise for the shares? Well, again, you could say that you are holding the call plus bond portfolio or the call plus cash. And now this changes things. What are you insuring now? Well, you see, in the first case, if you were holding a call and you're saying it's insuring the downside, well, you're also holding a call here. Isn't it also insuring the downside? No, it's not. Because the cash is now acting as the hedge. And what you're saying is, look, I didn't want to buy the stock. I do have the cash for it, but I really am fearful of it, so I'm just going to park it in this bond. And so this cash is acting as my hedge. If the stock crashes, I've got most of my cash. I'm going to take a little bit of it and buy this call option. And if you do that, you are insuring the cash against a missed market rally. You are not insuring the downside. You've already got that insured by the bond. So if we look at our payoff diagram, if we look at call plus cash versus stock plus put, look at this. Now they are absolutely identical. This is our replicating portfolio. So think about this. If you have the cash, it's taking the place of the put. So now these two get knocked out of the equation, and what's the call acting as a substitute for now? It's acting as a substitute for the stock. So now the call is insuring about missing out on the upside. Now, normally we don't say that that's a risk, it's a missed opportunity, but that's what you're doing. And that's why you have to be very careful about why you're buying a call. Are you buying a call because you are just trying to get through maybe an earnings report, but you do have the cash and you're going to exercise? That changes the way you should approach that strategy. On the other hand, are you buying a call because you have no desire whatsoever, or maybe just don't even have the cash to buy the shares? And that greatly changes the strategy too, because you're insuring different things. And yet, if you talk to a lot of traders, whether they're willing to exercise for the stock or not exercise, they treat the positions as the same. And you really need to be careful of it, because in these two cases, as I've shown, the call is insuring different aspects of the trade. So in summary, if you don't have the cash to exercise a call, the call is insuring the downside, just like a put. And in this case, you could make an argument that the buyer and seller benefit. Yeah, it's not fun to see your call option go to zero, to go up in smoke, but at the same time, you didn't buy the shares. You bought it as an insurance policy. And so that's why we could make the argument that both people benefited. In other words, you're saying if the call expires worthless, then your insurance paid off. And just like if you wreck your car, it's not an ideal situation, but we would say in those cases the insurance company lost and you were the beneficiary of it. And so that's really what's happening, even though your call option lost money. And again, that's because you didn't have the cash to exercise. However, if you do have the cash to exercise a call, then the call is insuring cash from a missed market rally. And in this case, if the market rises, the call buyer wins and the seller loses. So depending on what you're doing and your reasons for buying a call, they can greatly change what you should be hedging. If you're treating all call options in all situations the same, you're missing out on some of the very benefits that options provide. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new Greeks for 2025. Also, a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.